In my latest Globe and Mail financial facelift, I was able to guide Kurt and Elaine with what's becoming a very common financial planning objective. So this article was less about their retirement security and the longevity of their assets, and more focused on the transition of their wealth now to their daughter. More specifically, how can they help their daughter enter the housing market with a sizable down payment, and how to get the funds from their hands into their daughter's hands the most tax efficient way. So Kurt and Elaine are in a very comfortable financial position. They've retired, they have over 6.8 million in net worth, with 4.8 million in their RSPs. Their RSPs alone last year gained over 1 million. They've spent 30 years maximizing contributions and invested steadily in equities. They've done well, and their balance sheet reflects their discipline and their solid portfolio management. When they reached out to have this assessment completed, their first thought was, well, we have 4.8 million in their combined RSPs. Let's just use that account, pay the tax, and move on. And on the surface, this makes sense because when you look at their balance sheet, it's their largest account and their greatest pool of capital. The problem with this strategy is not about taxable income, because withdrawals from the RSPs or the RIFs, these are undoubtedly going to be taxed. The problem that they didn't consider is how much of their income will be taxed above 50%. So in Ontario, there's a tax bracket that in my opinion is worth avoiding, especially in retirement. At income above $253,000, CRA is going to keep over 50% of every taxable dollar. In other words, you make $1, or in this case, you withdraw an extra dollar, CRA gets 53 cents and you get 47. In my opinion, this is a penalizing tax bracket and worth avoiding if possible. This means to give their daughter $500,000, they have to withdraw over $1 million from their RSPs. So to solve this problem, we looked at the composition of their net worth. So their RSPs, they have 4.8 million. These are fully taxable upon withdrawal. Their non-registered account, 280,000, where they're going to pay only capital gains, and their TFSA is worth about 150,000, which is all tax-free income. The second option we explored is to use all of their TFSA funds and the remainder from their non-registered portfolio. This would be the optimal decision if their goal is to raise the funds with the lowest amount of tax. So I like this decision. It would be the optimal route if their goal is to raise the funds with the lowest amount of tax possible. However, what I don't like is that although they're going to pay a really low rate of tax, it completely drains their TFSAs, which removes some future flexibility from their own retirement plan. Keeping a pool of tax-free funds for large withdrawals, emergencies, is an important part of their overall retirement plan. The third option we reviewed is a balance between the two extremes. It combines using all of their non-registered portfolio and bumping up their RSP withdrawals. With their non-registered joint portfolio, they will only be taxed on the unrealized gain and then only report 50% of that gain. So they can still extract a lot of capital without huge tax consequences. So in this option, they're still going to experience a one-time spike in their income, but they can be more strategic and bring their income up to their desired threshold. In this case, the 253,000 without going over. Furthermore, if they can split the capital gain over 2 calendar years, they can smooth that one-time spike. By withdrawing a portion in late 2025 and the rest in 2026, we can split the income over 2 tax years. This keeps their overall taxable income below the top flight tax bracket in both years. So it requires a bit of patience and parking the cash for a few months, but this simple timing maneuver saves them significant dollars in taxes compared to the lump sum withdrawal directly from their RSPs. So I like this strategy and it works well for 3 reasons. Firstly, they've avoided that punishing 53% marginal tax rate. Secondly, they've preserved some of their TFSAs for future use for their own retirement. And lastly, they're able to give their daughter the desired amount without a disruption to their own retirement plan. So understanding and navigating tax brackets is an important component of a comprehensive financial plan. Exploring and analyzing these scenarios through a detailed financial planning document allowed us to determine and identify all options for Kurt and Elaine. What makes this case so interesting is that retirement security is never the issue. The real objective is about timing, tax efficiency, and making sure their generosity didn't unintentionally trigger negative tax consequences. We're seeing more families in similar scenarios. Strong balance sheets, significant RSPs, and a desire to help the next generation sooner rather than later. If you're wondering how your own accounts would respond to a large withdrawal, it might be worth reviewing the numbers before making that move. Increasingly, we're seeing clients who have done well financially shift their focus from will we be okay to how can we help our children now. This shift changes the planning conversation. It becomes less about accumulation and more about coordination between tax brackets, timing, account types, and long-term flexibility. So if that sounds like a conversation you're starting in your own home, make sure the numbers are guiding the generosity.